retirement accounts to Amazon, breaking even in groceries for the first time ever. The Fed may be quiet for now, but the market isn't. And remember, your future shouldn't be a guessing game. If you want a real financial strategy, call us at 888-988-JOSH or go to Jalinski.com. That's 888-988-5674. This just in, revolution, 401k revolution. Alternatives are in. According to Reuters, Trump is signing an order broadening access to alternatives. A new executive order opens the door for crypto, PE, and real estate assets inside of your employer-sponsored retirement plan. Is this diversification or deregulation run amok? The Trump administration has signed an order enabling fiduciaries to offer access to non-traditional assets in the workplace retirement plan. So, Jim, you get to invest in private equity. You have a desire to do that?
Absolutely not.
Absolutely not. What about hedge funds?
Hedge funds, yeah.
Or crypto in your 401k? Do you want to buy some crypto in your 401k?
Nah.
Supporters say it democratizes access to strategies normally rich people get. Critics warn it increases risk for average investors unprepared for opaque strategies and volatile markets. Well, what's changing in 401ks? So right now, due to Obama-era fiduciary rules, the other thing, I don't like that this is an executive order. I am calling on Congress to make this a law. For too long, presidents have controlled your 401k. Did you know that? President Bush, President Obama, now President Trump. I don't want a president to issue some executive edict that influences my biggest retirement asset or your biggest retirement asset. Do you, Jim?
Nope.
I want them to pass a law, debated in Congress. Here are some rules that people passed. There were the Obama-era fiduciary rules in 2012. There were the DOL regulations, Department of Labor. I want them to pass a law instituting this. What is my opinion? Well, you're going from plain vanilla mutual fund, the Acme Mutual Fund filled with S&P 500 stocks, to multi-asset type portfolios. There's much risk to this. Private equity funds are usually where money goes to die, Jim. It is far better for the average person to mostly be in ETFs, index funds, passive mutual funds, passive ETFs, than the complexity, fees, and liquidity concerns for average investors. Remember one time I bought a private, I've only done private equity once, and to be frank, I sort of regret it. I bought shares in a Macy's.
It should have been Costco.
And no, not Macy's stock, but it was like a real estate deal where people would invest. And the idea was that they were converting malls to Amazons. And it really didn't. You know, they ended up selling to some other group. And I really didn't make anything. And my money was tied up for, I don't know, a few years. So, but I only put in a small amount of my net worth. Big amount for some, but, you know, so if I told you how much I put in there, people would be like, whoa, you know, that's a lot of money. But for me, it was like, I'll give it I just got my money back this year. And generally, the people who make money in PE are the BlackRocks of the world that are pushing this crap on the everyday investor. So buyer beware. However, I think it's good. Although there's a risk, I'm all for freedom of choice in your 401k. I don't like that President Obama's fiduciary rules in 2012 really have dictated that your 401k is only in 10 or 20 different index funds and you can't invest in anything else. I actually think we should have freedom to invest in whatever we want, right, Jim?
That's correct.
Within the 401k structure. However, so I'm okay with this edict, but I want it to be a duly passed congressional bill, not an executive order. Now, the upside, they say, are for potential returns. I have not seen that private equity provides any higher return on a consistent basis than the S&P 500 and lower correlation with stocks. Again, that's what they tell you. So as a financial advisor, I would say don't do this. But as a freedom-loving patriot, I say go ahead, pass this edict. I'm fine with it. But you have a fiduciary duty to yourself. There are things advisors and you, the listener or viewer at home, should consider when recommending these new options. So if you run a 401k for your company, call us at 888-988-JOSH. We can book a free strategy session and make sure your company is protected from increasing liability. Now, some might say, what type of alternative investments, if any, belong in a retirement plan? I'm okay with opening up new asset classes like Bitcoin, which over the last 15 to soon to be, Bitcoin's going to be around soon for like 16 years next year, right?
Yeah. That's what you said.
I don't know. 15. It's 15, right? I don't know. Oh, wait. My brain's fried. 17 years
17.
This year. So it's kind of a longer asset class. So I'm okay with new asset classes entering in your retirement plan. However, some of these private equity funds are opaque, have high fees, and there are ways that the BlackRocks of the world, and I have nothing against BlackRock per se, but the large money managers are looking to make higher fee revenue by sandwiching these in your 401k. So I'd be careful. So be careful. And how can you benefit of these things? Well, we'll talk to you about that. If you want to learn how to navigate what's in your 401k or your retirement plan, we can help. Book a free strategy session at 888-988-JOSH, 888-988-JOSH, 888-988-5674. We'll be back after these messages with a major AI merger that you need to know about. We're talking CoreWeave's $9 billion merger hitting turbulence. Up next, this is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski. You can follow me on Twitter at YourFinancialQB. Check us out on YouTube. Search for The Financial Quarterback. Hit the subscribe and follow button. A major AI infrastructure deal is facing major investor pushback, highlighting the risks of high-flying tech deals and stock-based acquisition. Some of me thinks that all this is just some type of charade, right? CoreWeave proposed a $9 billion acquisition of Core Scientific. It's being questioned by shareholders, and rightfully so, over dilution, valuation, and post-deal volatility. Critics worry that this growth at all costs approach might not deliver long-term value. The deal is also a bellwether for how Wall Street sees the infrastructure behind the AI boom. Why CoreWeave wants Core Scientific? Energy-efficient data centers for AI compute power. What are investors worried about? Well, volatility in the stock market and dilution of their shares, along with no hard cash being given to the investors. Mergers acquisition strategy in a high-rate environment. Deals require stronger fundamentals now. And how can you spot red flags in these stock-driven deals? Are AI infrastructure deals overhyped or still undervalued? I think the there is value to the brick and mortar behind the cloud. Because with the AI and the data centers we're going to need brick and mortar behind the cloud. We're going to need bricks and mortar behind AI. Energy, cheap, abundant energy sources. So there's an opportunity here. The peril is there's only going to be a few winners in this. Now, most investors should not trust a stock-based acquisition. They should trust cold, hard cash. So if you hold stocks involved in mergers, make sure you're not caught holding the bag. Let's review your positions. Call 888-988-JOSH. And here's another kind of investor alert. Beware of AI as an investing play. A lot of the companies really behind the AI infrastructure, you can't go out and buy their stock. Some you can. There are data centers, semi-modular nuclear reactor companies, jet engine companies, chip companies that you might want, semiconductor companies you might want. But be careful. Do your own due diligence. Just don't go into something if your friend says, hey, I got a hot stock tip. It's usually not a good friend. Run away. And call us, 888-988-JOSH. We're going to talk next about a major development. And when I say major, it's probably the biggest development I'm going to reveal today. And it has to do with there is $7 trillion of money waiting on the sidelines. This $7 trillion, according to Barron's, could be the next big boom. I'll talk to you about it when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. Nobody has a dial anymore, right? But it's good to say. It's like, what do you swipe left, swipe right?
Don't push that button.
Click on the screen. I don't know what you'd say now. With $7 trillion sitting, guess what? In money market funds. That's in money market funds. There's probably a lot more sitting in cash accounts at large banks earning a pittance. 0.3%, 0.1%. There could be a wave of capital rotation from money market funds that could push stocks even higher. Which reminds me, I want you to take a look at your bank accounts. Money markets, CDs, savings accounts. And ask your bank, am I earning any interest? Look at your statement. What we found is many of you aren't even in a money market fund where you could make 3.5 to 4.1% right about now. Rates are subject to change based on the Fed or the pressure the president is putting on the Fed, which might be to cause those rates to go down. Yet a lot of people, they go, Josh, I'm fine. I'm making good money on my money market. But they forget just 6 years ago, you would have begged for a 4% CD loan, a 4% money market. So in a low-yielding universe, a 4% money market looks pretty good. You got to realize that cash, although no longer trash, is a trap. Because if rates go down, your money market fund's going to go down. Where you could have just locked in those higher rates for longer. There are other risks in holding cash for too long. The money doesn't have the opportunity to grow to offset the risks of inflation. Money market funds have swelled to record highs as investors chase safety amid rate uncertainty. But analysts are now suggesting that this cash hoard could soon rotate back into the market as investors fuel another rally by chasing yield and growth. Cash is on the sidelines. $7 trillion of money parked by retail, that's you, the mom and pop investor, and institutions. So if there is a reallocation into stocks, there could be another boom because all this money's in the sidelines. I think this could be a bullish signal, so you have to be careful. But to me, that's a very optimistic sign that there's all this cash on the sidelines and the market is still going to all-time highs. Should long-term investors lean into growth now while others wait? So it's important that you, the long-term investor, know that you lean into growth, not just sitting money in cash on the sidelines. Cash is good for emergencies and a 6-month reserve. So be careful that you don't kind of, the show's called The Financial Quarterback, right? You have to have a strategy to win the game. And part of it is, yes, having money market funds for emergencies. But anything beyond, 12 months in the bank, you're losing money to inflation, which is a stealth tax that affects everybody who just keeps money on the sidelines. Waiting on the sidelines can be expensive. Let's build your game plan today for action by calling 888-988-JOSH. Do you have money sitting on the sidelines? Don't know what to do with it? Would you like to get higher yields for longer? Give me a call. 888-988-JOSH, 888-988-JOSH. Next up, Eli Lilly powers ahead. Is biotech back? And this is Josh Jalinski, the financial quarterback. We're live on Twitter, video, YouTube, taking your calls. Eli Lilly powers ahead. Is biotech back? According to a Eli Lilly press release at investor.lilly.com/news releases, Lilly's blockbuster second quarter reignites interest in healthcare and shows the power of innovation-driven revenue. Jim, do you take any of those fat drugs? Probably not the politically correct word for it.
Did you just say fat drugs? No.
I know people, people you wouldn't think take it. They take it.
Ozempic and stuff like that, yeah.
Mounjaro, Zepbound. I've thought about taking it. Why work out and exercise? You can just take an injection. You know what? Take a pill and you're fine.
Don't discuss that with Joanne.
Eli Lilly posts a 38% year-over-year revenue growth with $15.6 billion with a B driven by drugs like Mounjaro. As inflation cools and aging trends accelerate, healthcare may become a core growth sector again, even as tech steals the spotlight. Where the growth is: diabetes, weight loss, Alzheimer's trials, pharma strength, and biotech risk. There's growth right now in diabetes drugs, weight loss drugs, and Alzheimer's trials drugs. Pharmaceutical strength versus biotech risk. You need to balance blue chip stability with innovation and market implications. Healthcare often outperforms in late cycle economies. And we may be late to the bull market party. Although if the bull market technically began in 2023 after that correction, we should have like 7 years theoretically in the bull run. Now, tech is stealing the spotlight, but healthcare may become a cool growth sector again as inflation cools and aging trends accelerate. What are the market implications? Should investors view this as a rotation opportunity in healthcare? Well, that's one thing we would look at if you want us to examine your portfolio. Do you have any healthcare exposure? Shouldn't have, all your money there, but you could. Now, how do you position for both growth and downside protection? If you're unsure how to invest in a world of shifting trade winds, we can help. Call 888-988-JOSH or go to Jalinski.com for more. And that's the thing. You want to look at having different asset classes, not just everything into one. And Allianz is signaling a trend. European stocks and companies are not all dead. I'll talk about that and more when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback, talking about Allianz posting a record profit, signaling that not all the opportunity is in U.S. markets. Allianz saw an 8% increase in business volume and its highest operating profit in years. In a world dominated by U.S. tech, this is a strong reminder that international insurance and asset management companies still hold strong value. What's driving growth? Risk management products, diversified income products, and disciplined balance sheets. Portfolio impact. Are international dividend payers due for a comeback? And currency plus inflation strategy. How to hedge foreign exposure. Well, you got to be careful when you're buying certain stocks that trade on foreign exchanges. There could be currency risk. You may want to look at buying the U.S. equivalent. Is now the time to rebalance toward international holdings? Well, international stocks have done well this year, and you need to be careful of kind of going in something after it's done well. How can insurers act as a hedge against rate volatility? Well, insurance companies may be a way to diversify in the global markets, but also insurance companies are excellent bond managers, so they know how to play some of the rate games. Now let's explore what's working beyond the U.S. borders. Call 888-988-JOSH, 888-988-5674, or go to Jalinski.com for more. Up next, we'll talk about Amazon's grocery gamble that is paying off. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And if you could stop, I have to make a